Hey, it's Nolan Mathias from Mortgage 360, and today we are talking the CMHC underwriting guidelines and the changes that they've made to insured mortgages, at least within CMHC. But before we get into the details, please hit that subscribe button, hit that notification bell, and please hit the like button, because ultimately it is up to you how many people see this video. And quite frankly, this one's an important one. So let's talk about what happened. Yesterday, Thursday, June 4th, Evan Siddall of CMHC announced that they were going to change their underwriting guidelines. Now, this is important to understand. CMHC is changing their underwriting guidelines. They don't control what Genworth and Canada Guarantee, the other two insurers, do, and they certainly don't control what the banks do and financial institutions do with respect to debt servicing ratios and different guidelines. Obviously, if you want a CMHC mortgage, you're going to have to follow their new guidelines, but for all intents and purposes, the changes so far are only to CMHC insured mortgages, and those are new mortgages effective July 1st. So here's what they did. And what they did is they said, we're going to take another look at debt servicing ratios. We're going to take another look at insured borrowers and credit. Now, we talked about this in our previous video where the media had grabbed on to the fact that Evan Siddall had suggested that 10% down payments were a more prudent lending practice than 5% down payments, which was obvious. And I talked about the fact that what Evan Siddall was talking about when he testified at the House of Commons was that he was talking about the fact that there's less risk involved with higher down payment mortgages, and that they were going to probably take a look at the underwriting guidelines for their most risky borrowers, which is 5% down borrowers. And that's exactly what they did. And what they did was they reduced debt servicing ratio. So gross debt servicing ratio, which is the amount of money that can go to your mortgage payment, to your taxes, and to your heating costs, down to 35%. And then they also reduced the total debt servicing amount for all of your debts. So the percentage of all of your income that can go towards your debts and mortgage obligations. So that includes things like credit cards and lines of credit, to 42%, was previously 45%. So what they've basically done is they've said less of your income can go towards qualifying for a mortgage, which is essentially the same thing that the stress test did a couple of years ago. And quite frankly, this change is about the equivalent of an impact that the stress test had back in whatever year it was that they put that in. They're all kind of melding together for me now. So this is a pretty big impact with respect to getting a CMHC insured mortgage. Now, to put it in perspective, when I started in the industry back in 2003, the debt servicing ratios across the board, it didn't matter where you got a mortgage, were 32 and 42. So you could have 32% of your income go towards your mortgage payments and 42% go to all of your debt obligations. And, that was relaxed over the years. And then, they never really brought it back. Even though they introduced the stress test, they never really brought back the debt servicing ratios. And the stress test and the debt servicing ratios have the exact same effect. Reducing them or introducing a stress test basically allows you to qualify for less. So that's the key change. And again, what's important to note is that the other insurers so far haven't said that they're going to follow suit. Now, they're probably going to get a lot more stringent on how they're underwriting, because what they don't want is they don't want to catch all of the borrowers who are putting less than 20% down that CMHC won't insure. That's not the business that they want to be in. But they're probably going to continue to look at those slightly higher risk borrowers. Now, the other thing that they've done is they've said, okay, we're also going to require that at least one borrower have a minimum of 680 beacon score. So basically what this means is one of you, if you're in a couple, has to have at least made all of your payments on time for the last 3 or 4 years and doesn't have all of your credit cards run up to the limit. As long as you haven't done those two things, so as long as you haven't missed a payment and as long as you aren't using all the credit that you have, you're pretty much good. You're going to have a 680 beacon score. No problem. Super easy. But if you missed a payment or you have, $10,000 worth of credit cards available to you and you've used 10,000 or worse, you're over limit, you're definitely going to be affected by this. So the key thing is make sure that your credit score is good, make sure that you're making all your payments, and make sure that you aren't utilizing all the credit that's available to you. Now, the other thing that they've said is that they're not going to do basically borrowed down payments, which for all intents and purposes isn't really a big issue because not many people do them. I know at our company, we are adamantly opposed to borrowing money off a line of credit or a credit card in order to purchase a property and using that as your down payment. So it's just been something that internally we've had a policy of not doing it because we think that it's one of those slippery slopes to ending up in a really, really bad situation. So it's just like we're that B Corp certified honesty, transparency, accountability sort of thing. And the one thing that we never wanted to see was somebody borrow their down payment when they didn't have the ability to save for it prior. And if they didn't have the ability to save for it prior, they probably weren't going to get to the point where they could afford to pay off that down payment once they have a big mortgage to pay. So, we don't think that that's a big one, but we do think that, this reducing debt servicing ratios does have a similar impact to what introducing the stress test had a few years ago. And here's what's really interesting. What's really interesting is that when they introduce the stress test, when they have made previous changes, it's usually because, the Toronto market and the Vancouver market are really hot. We expect values to go up, and therefore we want to make it harder for people to qualify. That's been the reasoning in the past. Now this is the opposite. Now this is Evan Siddall saying, okay, now we're worried about prices going down, so we're going to do the same thing that we would have done when prices were going up. It doesn't really make a ton of sense. It makes sense from the perspective of making sure that borrowers can actually afford the mortgages that they're getting. But from the perspective of timing, like, talk about a shitty time to do it. You've basically got this pandemic thing happening. You've got, softness in the market to begin with. And now you're just going to, try to kill demand by changing the way people qualify for mortgages. And here's what we know about any time the government makes changes like these, or CMHC makes changes like these. As a mortgage company, we get a heck of a lot busier, because what this does is it incites panic and makes people get off the fence, and it makes them think that they have to go out and buy. So let me be really clear. Nobody else has made this change yet, just CMHC. You don't have to go panic buy a property right now because, you heard that CMHC made changes. You've still got time. We're still going to see over the next few days how this filters out and whether Canada Guarantee and Genworth follow suit, and basically how this plays out in the market over the next week or two. It's going to be definitely interesting. My guess is that most of the lenders and the insurers are going to say, CMHC, not sure we agree with you on this one, but that has yet to be seen. So that's the information we have so far. I will update you guys as information comes available. And once again, for the most up-to-date and the most honest and transparent information, where to subscribe, where to hit the notification bell, and you definitely know which video to like. That's this one. Thanks. We'll talk to you soon. Have a great day.